The clock is ticking on a decision that could reshape retirement income for millions of Americans this December. While most people are focused on holiday preparations, something significant is happening behind closed doors in Washington that deserves your immediate attention. Right now, policymakers are reviewing a substantial adjustment to Social Security benefits. We're talking about a potential $2,100 increase that could land in eligible recipients' accounts sooner than you think. But here's what nobody's explaining clearly. This isn't your standard cost of living adjustment, and it won't automatically apply to everyone. The proposal currently under review involves specific eligibility criteria tied to income thresholds, filing status, and when you initially claimed benefits. Understanding these details now, not after the decision is finalized, could mean the difference between receiving this increase or missing out entirely. What makes this December review particularly critical is the compressed timeline. Unlike typical Social Security changes that go through months of public commentary, this adjustment is being fast-tracked through a different legislative process. That means the window for preparation is narrow, and most beneficiaries don't even know what's at stake or what actions they might need to take to qualify. Let me be completely transparent with you about what's actually happening right now because there's a lot of confusion swirling around this December review. And frankly, some sources are making claims that just don't match up with how Social Security actually works. The $2,100 figure that's being discussed isn't a simple across-the-board payment that everyone will receive automatically. Instead, what we're looking at is a complex proposal that ties into several different aspects of the Social Security system. And understanding how these pieces fit together is absolutely crucial if you want to know whether this could affect your monthly income. First, let's talk about where this number is actually coming from, because context matters enormously here. The Social Security Administration operates on very specific formulas and regulations that have been refined over decades. Any change to benefit amounts has to go through either legislative action or regulatory adjustment. And right now we're seeing a combination of both happening simultaneously. The $2,100 increase that's under review isn't necessarily $2,100 per month added to your check. What it actually represents is an annualized figure that breaks down differently depending on your individual circumstances, your earnings history, and when you started claiming benefits. For some people, this could translate to an additional $175 per month. For others, it might be structured differently based on supplemental adjustments or catch-up provisions that apply to specific categories of beneficiaries. Now, here's where things get really interesting. And this is information that doesn't always make it into the mainstream coverage. The Social Security system has always had what are called hold harmless provisions and various protective measures designed to prevent beneficiaries from losing ground financially due to increases in Medicare premiums or other mandatory deductions. What's being reviewed this December includes potential modifications to how these protections are calculated and applied. For years, certain beneficiaries have been held at lower benefit levels because the standard Medicare Part B premium increases consumed their entire cost of living adjustment. This created a situation where some people saw no increase in their actual take-home amount, even when Social Security announced COLA adjustments. The current review is examining whether a correction mechanism should be implemented to make up for years when these individuals effectively received no real increase in their purchasing power. The timing of this December review is particularly significant because it intersects with several different policy discussions that have been brewing in Washington for quite some time. There's been ongoing debate about whether Social Security benefits have kept pace with the real costs that seniors actually face. While the official inflation calculations use the Consumer Price Index for urban wage earners, many policy experts have argued that this doesn't accurately reflect the spending patterns of retirees who typically spend a much larger percentage of their income on healthcare and housing than the general population. Some proposals being reviewed this month would implement a supplemental adjustment specifically designed to address this discrepancy, essentially acknowledging that the standard COLA formula has been systematically underestimating the inflation impact on seniors. Let me walk you through how eligibility for this potential increase is being structured, because this is where many people get confused, and it's absolutely critical to understand. The proposal under review isn't treating all beneficiaries the same way. Instead, it's using a tiered approach based on several factors. One of the primary considerations is your primary insurance amount, which is the benefit you're entitled to at your full retirement age before any adjustments for early or delayed claiming. People whose PIA falls below certain thresholds would be prioritized for the larger adjustments. Additionally, the proposal looks at how long you've been receiving benefits. Those who claimed early and have been living on reduced benefits for many years would potentially see larger adjustments than people who waited until age 70 and are already receiving maximum delayed retirement credits. The reasoning behind this approach is that early claimers have experienced more cumulative impact from inadequate COLA adjustments over time. Another crucial element that's part of this December review involves what's called the earnings test and how it interacts with people who are still working while receiving benefits. Currently, if you're below your full retirement age and still working, Social Security reduces your benefits by $1 for every $2 you earn above a certain threshold. What's being discussed now includes potential adjustments to how those withheld benefits are recalculated and returned to you later. The current system does eventually give you credit for those withheld months by recalculating your benefit at full retirement age, but many experts argue that the adjustment formula doesn't fully compensate for the time value of money and the impact of inflation during the withholding period. The new proposal would provide a supplemental catch-up payment to people who had benefits withheld due to the earnings test, essentially making them whole for the real economic impact of that policy. There's also a component of this review that deals specifically with divorced spouses and survivor benefits, which is an area that's often overlooked in discussions about Social Security reform. Under current rules, divorced spouses can claim benefits based on their ex-spouse's earnings record if the marriage lasted at least 10 years. However, the formula used to calculate those benefits hasn't been updated to reflect modern economic realities, particularly for people who may have left the workforce to raise children or who worked part-time to balance family responsibilities. The December review includes provisions that would provide supplemental adjustments to divorced spouse benefits to better recognize the economic contributions and sacrifices made during marriage, even when those contributions didn't result in traditional W-2 earnings. Now, let's talk about the mechanics of how this would actually be implemented if the review results in approval, because understanding the timeline and process is essential for planning purposes. Unlike regular COLA adjustments that take effect in January, this supplemental increase would potentially be processed through a different mechanism. The Social Security Administration would need to conduct individualized reviews of millions of beneficiary records to determine exact eligibility and calculate specific amounts. This is a massive administrative undertaking that would likely be rolled out in phases. Initial payments might go to the most clearly eligible recipients first, with more complex cases being processed over subsequent months. The SSA has indicated that if approved, they would aim to have the first round of payments issued before the end of the first quarter of next year. But that timeline could shift depending on the complexity of implementation and any technical challenges that arise. One aspect that's generating particular interest among policy watchers is how this proposal addresses the situation of people who are receiving both Social Security retirement benefits and supplemental security income. SSI recipients are generally individuals with very limited income and resources, and they face unique challenges because increases in Social Security benefits can sometimes result in reductions to their SSI payments, creating a situation where the net benefit is much smaller than it appears. The current review includes language that would treat this supplemental adjustment differently from regular Social Security income for purposes of SSI calculations, at least partially shielding it from the dollar-for-dollar offset that normally occurs. This would represent a significant policy shift and could provide meaningful additional income to some of the most financially vulnerable seniors in the country. The healthcare cost component of this proposal deserves special attention because it represents one of the most innovative aspects of what's being reviewed. For years, seniors have struggled with the gap between Medicare coverage and actual healthcare expenses. Even with Medicare Parts A, B, and D, out-of-pocket costs for things like dental care, vision care, hearing aids, and various co-payments and deductibles can consume a huge portion of a fixed income. The supplemental increase being reviewed includes a healthcare cost offset component that would provide additional funds specifically calibrated to average out-of-pocket healthcare spending for people in different age brackets. The recognition here is that a 75-year-old typically faces different and higher healthcare costs than a 65-year-old, and the adjustment attempts to account for that reality. This means that the actual dollar amount of the increase could vary not just based on your benefit history, but also based on your age, with older beneficiaries potentially receiving larger supplemental amounts. Another critical factor in this December review involves the treatment of government pension offsets. Many teachers, firefighters, police officers, and other public employees worked in jobs that didn't pay into Social Security but instead contributed to separate pension systems. Under current rules, the government pension offset and windfall elimination provision significantly reduce Social Security benefits for these individuals. These provisions have been controversial for decades, with affected retirees arguing that they're being unfairly penalized for public service careers. The supplemental adjustment being reviewed includes partial relief from these offsets, though not complete elimination. The proposal would provide a supplemental payment to individuals affected by GPO and WEP that would restore some, though not all, of the benefits currently being offset. The exact percentage varies depending on the specifics of your pension and work history, but advocates are calling this a meaningful step toward addressing what they view as a long-standing inequity in the system. Let me address something that's causing a lot of confusion and, frankly, some unnecessary anxiety. There have been claims circulating online that suggest you need to take specific action or file additional paperwork to receive this increase if it's approved. In most cases, that's simply not accurate. The Social Security Administration has been very clear that any approved adjustments would be processed automatically based on existing records. You don't need to file a new application, you don't need to contact your local Social Security office, and you absolutely should not be paying anyone who claims they can help you qualify for this increase. The SSA has all the information they need in their existing database to determine eligibility. The one exception would be if there's an error in your earnings record or if you have unusual circumstances that aren't properly reflected in the system. In those cases, you might need to provide documentation, but the SSA would contact you directly if that were necessary. They will never ask you to provide sensitive information via email or text message, and they will never ask you to pay a fee to receive benefits you're entitled to. The funding mechanism for this potential increase is also worth understanding because it affects the long-term sustainability of the proposal and the likelihood that it will actually be implemented as currently structured. Social Security operates through dedicated trust funds that are funded by payroll taxes. Any increase in benefits has to be funded either through additional revenue or through adjustments to other parts of the program. The current proposal includes a combination approach. Part of the funding would come from technical adjustments to how benefits are calculated that would slightly reduce the rate of growth for very high earners, those whose benefits are calculated based on earnings above the current taxable maximum. Another portion would come from closing certain loopholes that allow some high-income individuals to minimize their Social Security tax liability. There's also a component that involves adjusting the taxation of Social Security benefits for individuals whose total income exceeds certain thresholds. These changes wouldn't affect the majority of beneficiaries, but would redirect some resources toward the supplemental adjustments being discussed. The political landscape surrounding this December review is complex and worth understanding because it affects both the likelihood of approval and the potential for modifications before final implementation. This proposal has bipartisan support in principle, with lawmakers from both parties acknowledging that many seniors are struggling financially and that Social Security benefits haven't kept adequate pace with real-world cost increases. However, there are disagreements about the details, particularly around the funding mechanisms and the specific eligibility criteria. Some legislators want to see the adjustments targeted more narrowly to the lowest income beneficiaries, while others argue that the middle-class retirees who don't qualify for programs like SSI but still struggle to make ends meet should be the primary focus. These negotiations are ongoing, and it's entirely possible that the final approved version will look somewhat different from what's currently being reviewed. That's why it's important to stay informed through reliable sources rather than assuming that any particular version of the proposal is guaranteed to be implemented exactly as initially described. What happens next depends on how the review process concludes and whether the necessary regulatory and legislative approvals can be obtained within the available timeframe. The December deadline that's been discussed isn't arbitrary. It relates to budget reconciliation processes and fiscal year planning that affects how federal programs are funded and administered. If the proposal is approved this month, implementation would begin in early 2025. If it doesn't receive approval during this review period, it doesn't necessarily mean the idea is dead, but it would likely mean delays of several months or even longer as the proposal goes back for revision and reconsideration. The urgency around the December timeline is real, because window of opportunity moments like this don't come along frequently in the world of Social Security policy.